My name is Emily Foshag, and I'm a portfolio manager at Principal Asset Management, leading our listed infrastructure investment capability. We think the first reason why investors should be considering listed infrastructure in today's environment is really because of the expected fundamental resilience of these businesses. And that's driven by a couple of areas. The first is we continue to expect stable cash flow generation from this space. At Principal, we're very much focused on core providers of essential services that operate as regulated or contracted monopolies, regulated utilities, transportation infrastructure, airports, toll roads, freight rail operators, energy infrastructure, both traditional as well as renewable energy infrastructure, and also communications infrastructure, such as cell phone towers and data center. And what those businesses all have in common, ultimately, is that they are providing essential services that really have limited volatility around the macroeconomic environment. Some of them more so than others, and as an active manager, you have an opportunity to position accordingly. But relative to your average business in the global equity universe, these businesses are expected to be quite resilient, regardless of what the macroeconomy brings their way. The other point that I've been making is that listed infrastructure is and will continue to benefit from pretty significant structural growth trends, whether that's the clean energy transition that's driving massive investment in renewables, in electricity networks, and in some of the newer technology deployment around green hydrogen, as well as carbon capture and storage. You also have significant tailwinds related to demographics. Globally, you have shifts in middle class. You also have shifts in economic power that mean that people, for example, in emerging markets that typically take less than one flight a year, over the long term have an opportunity to more than double that to catch up to the travel patterns that we see in developed markets. In a place like the US, you also have more localized or more micro demographic shifts, such as people relocating from California or from the Northeast to parts of the Southeast or Florida. And that is driving different growth patterns depending on which state that you're discussing. And so again, demographics is something that is a long-term tailwind that you are able to identify and then invest accordingly. And that shift will continue regardless of what the macro is doing at a certain time. The last structural theme that I'd mentioned is really digitalization. Kind of simply, that really just means the fact that we are increasingly relying on data to run our lives. The expectation, regardless of whether there's a recession, is that mobile data demand increases at an annual rate of over 20% through 2027. That's quite significant, and again, is going to happen regardless of whether there's a recession or not. Again, this fundamental resilience, we believe, is quite powerful as it relates to listed infrastructure. The other piece of the story is around inflation protection, of course, right? Inflation protection is quite unique to infrastructure. And a lot of times when we talk about inflation protection, people understand in theory that infrastructure should have inflation protection, but don't necessarily take the time to think about why. And the why is really quite powerful. And that goes back to the fact that these businesses are operating as regulated and contracted monopolies. And so the regulators really create an environment, a regulatory framework where they're able to maintain business resiliency regardless of what's going on in the macro. And that translates into a differentiated ability to pass through inflation to end users. 2023 has actually been quite an interesting year if you think about it, because actually you've seen many businesses globally exercise significant pricing power. What we would point out, though, is that the consumer has remained strong over the last 12 months, even in the face of some consternation around how much can that continue. The minute you see the consumer weaken, we think that infrastructure margin preservation is going to be differentiated relative to other global equities. One more point that I would make around fundamental resilience really has to do with balance sheets and credit quality. Certainly for capital-intensive businesses like infrastructure companies, higher cost of debt is a headwind from an earnings perspective. We acknowledge that. What's quite differentiated about infrastructure when it comes to interest rates and balance sheets, however, is twofold. The first is that many companies operate under regulatory frameworks that, with some lag, have the ability to pass through higher interest rates to end users. In addition to the expected fundamental resilience that we see with listed infrastructure businesses, we're also quite excited about the valuation opportunity that we've seen open up over the last 9 months. Listed infrastructure stocks now, on average, trade at historically low discounts relative to global equities. We also now are going on 4 years of underperformance comparing listed infrastructure relative to private infrastructure. And so we think this is a great opportunity when you're thinking about medium-term returns to be entering the asset class. For investors that are willing to allocate across both public and private infrastructure markets, we believe that really public infrastructure can play a complementary role relative to private. The reality from our perspective, and this has borne out historically in long-term return series, is that listed infrastructure and private infrastructure offer comparable returns opportunities. They are similar businesses fundamentally as well. Many private infrastructure managers focus, as we do at Principal, on core infrastructure businesses, essential service providers operating under regulated or contracted frameworks. And so again, that fundamental similarity can be quite comparable between private and listed markets. Now, what you've seen, of course, is the listed infrastructure has underperformed private infrastructure quite significantly over the last few years. And we would argue that that has little to do with fundamental differences in the business. In fact, fundamentals in both private as well as listed infrastructure markets have been quite strong. However, public markets operate differently. And one of the things that's unique about public markets, of course, is that markets often overshoot both to the up and to the downside, and they react more readily to short-term fundamentals, and that influences the prices at which infrastructure stocks trade hands. In the private infrastructure markets, you don't have any actors that are really involved in the game from a short-term perspective. Part of it, of course, has to do that it simply takes a lot of time and resources to execute a private infrastructure transaction. So even if you wanted to fire sale an asset or decide tomorrow that you wanted to buy a new infrastructure company, you don't really have that flexibility or ability to act nimbly when it comes to accessing opportunities. And so when you get to this point today, we talked a little bit about the relative valuation opportunity that we're seeing in public versus private markets. But I'd also point to a couple of other things that we think are quite compelling relative to unlisted infrastructure at this point in time. The first is the diversification potential that you're able to achieve in a listed infrastructure portfolio. Obviously, we've seen a significant shift in monetary policy over the last 12 to 18 months. And that already has caused certain things in the global economy to break. Our view would be that we're not out of the woods just yet, and therefore the ability to maintain a diversified portfolio across geographies and sectors puts you in a better position that should an individual company or an individual asset have some challenges, it doesn't necessarily negatively impact to a large degree your ability to deliver strong absolute returns. So that diversification, I would argue, is quite important in today's environment. Liquidity, right, speaks for itself. It's liquidity in terms of the ability to access the market as quickly as possible. One of the things that we have seen is that private infrastructure transactions have closed down. And so oftentimes, if an investor is looking to allocate to infrastructure today, they have the best shot at getting money to work quickly if they do so in the listed markets. The other piece of liquidity, of course, is when you want to exit, you can do so very quickly, right? And that goes back to the importance of diversification as well. They're very related points. In public infrastructure markets, if there's a regulatory change, if someone has a balance sheet challenge that was unanticipated, if there is political noise that is changing your view around a company's ability to execute. All of those are reasons that in the public markets, you can simply choose to get out of that exposure and repurpose your capital elsewhere. You don't have that same flexibility, of course, in the unlisted markets. The third thing that we've been pointing to that's quite differentiated in today's environment is really around valuation transparency. In the past month, we've had a significant backup in yields. And in the public markets, what you're able to do is you're able to then say, all right, the stock that was trading 20 or 25% above where it's trading today has priced in what level of interest rates over the long term. And then you have ability to allocate capital with that assumption, making an assessment. Is the risk to the downside or to the upside, given what is priced into the stock? Obviously, it's a much different exercise in unlisted markets. You're not going to necessarily see that knee-jerk valuation reaction, but equally, it's not creating an opportunity to enter quality businesses at very compelling prices. The last piece that I've been highlighting is historically, private infrastructure assets have largely been mature, what they call brownfield assets, that are really kicking off a lot of cash flow. A significant portion of the total return for unlisted infrastructure historically has come from income. The problem is, of course, in today's environment, there are a lot of options for income, right? We see significantly higher yields available in high quality credit, whether it's government or corporate. We also see significant rates available in private credit opportunities. And so from my perspective, I think infrastructure as a yield story is definitely more challenged. Listed infrastructure, however, has historically been a nice combination between capital growth and income, such that historically about 2/3 of the return has come from capital growth. The income, of course, provides additional defensiveness, but we would argue you shouldn't be buying listed infrastructure ever purely because of the income. And of course, that story may resonate with investors more so in today's environment.